you're watching this right now, you're already ahead of the curve. You're not just another investor scrolling through headlines hoping for a tip or a lucky break. You're here because you understand that timing is everything, and that sometimes a single window of opportunity can make all the difference. The next 48 hours could be that window for gold and silver investors, not because of hype, not because of wild speculation, but because of a rare convergence of events that could reshape the entire landscape for precious metals. If you're ready to see what most people are missing and how you can position yourself before the crowd even wakes up, then stay with me, because what happens next could change everything. Let's start with the facts. Right now, the world's financial system is standing at a crossroads. Central banks are sending mixed signals, inflation is proving far more stubborn than the so-called experts predicted, and geopolitical tensions are simmering just below the surface. In the last 24 hours alone, we've seen gold and silver premiums spike in Asia, with Shanghai and Mumbai leading the charge. Meanwhile, Western markets are showing signs of stress, COMEX inventories are thinning, and bullion dealers are reporting record inquiries from both retail and institutional buyers. This isn't just noise, this is the market sending a clear message: something big is brewing. But what exactly is driving this urgency? Over the next 2 days, we're expecting a series of announcements and data releases that could act as a catalyst for massive price moves. The Federal Reserve is set to release its latest policy statement, and insiders are already whispering about a potential shift in tone, one that could signal the end of the tightening cycle and the beginning of a new era of monetary easing. If that happens, it's not just gold and silver that will react. Currencies, equities, and even crypto could see wild swings. But for precious metals, the implications are even more profound. Remember, gold and silver thrive in environments of uncertainty and loose monetary policy. If the Fed blinks, we could see a rush into safe havens like we haven't seen since 2008. Now let's add another layer: geopolitics. In the last week, tensions have escalated in the Middle East, with new sanctions, military maneuvers, and diplomatic standoffs making headlines. But what's not being reported is how these events are impacting the flow of physical gold and silver. Several major refineries in the region have quietly halted shipments, citing security concerns. At the same time, central banks in emerging markets are accelerating their gold purchases, moving reserves out of dollars and into hard assets. This isn't just a blip on the radar, it's a fundamental shift in how global wealth is being protected and transferred. And then there's the supply side. Silver, in particular, is facing a squeeze that's been building for months. Industrial demand is surging, especially from the solar and electronics sectors, while mine output is struggling to keep up. Just last night, a major mining company announced unexpected production cuts due to labor disputes and regulatory delays. The result? Spot prices jumped and premiums on physical silver widened even further. If you're waiting for a better entry point, you might be waiting forever. The window is closing, and the next 48 hours could be your last chance to act before the market reprices everything. But let's not just focus on the fear. There's opportunity here, massive opportunity for those who are prepared. If you understand the mechanics of the market, if you know how to read the signals, you can position yourself ahead of the crowd. That's what this video is about. I'm going to break down exactly what's happening, why it matters, and most importantly, what you can do right now to protect and grow your wealth. Let's talk about the psychology of the market for a moment. Right now, there's a battle raging between complacency and urgency. Most investors are still asleep at the wheel, lulled by years of easy money and rising stock prices. But the smart money, the insiders, the institutions, the central banks, they're moving fast. They see the writing on the wall. They know that when the tide turns, it turns fast, and those who hesitate are left behind. That's why we're seeing record outflows from ETFs and a surge in physical purchases. People are voting with their wallets, and they're voting for real assets. Contrast that with the mainstream narrative. Turn on the financial news, and you'll hear the same tired talking points. Inflation is transitory, the Fed has everything under control, there's no need to panic. But look at the data and a very different story emerges. Inflation is sticky, wages are lagging, and debt levels are exploding. The Fed is trapped and everyone knows it. The only question is when, not if. They'll be forced to pivot, and when that happens, gold and silver will be the first to respond. So what should you be watching over the next 48 hours? First, keep an eye on the Fed's statement and any hints about future policy. Second, watch for any escalation in geopolitical tensions, especially in regions that are critical to the gold and silver supply chain. Third, monitor physical premiums and inventory levels at major dealers. Here are the canaries in the coal mine. If premiums spike or inventories dry up, that's your signal that the market is moving faster than the headlines can keep up. And finally, remember this: markets move on expectations, not just reality. By the time the news hits the front page, the smart money has already moved. If you want to be ahead of the curve, you need to act before the crowd. That's what separates winners from losers in this game. We're just getting started. In the next section, I'll break down the specific catalysts to watch, the key data points that could trigger a market move, and the strategies you can use to capitalize on the coming volatility. If you're serious about protecting your wealth and maybe even multiplying it, stick with me. The next 48 hours could change everything. Now let's move beyond the surface headlines and get into the structural forces that are quietly building pressure beneath this market. Because what makes the next 48 hours so critical isn't just one announcement or one geopolitical flare-up, it's the collision of fragile confidence, tightening physical supply, and a monetary system that has far less room to maneuver than most people realize. Here's what most retail investors don't understand. Gold and silver don't need chaos to rise, they need doubt, and doubt is spreading. Over the last several months, we've watched policymakers insist that inflation is contained, that growth is stable, that the system is resilient, but at the same time, bond yields have been volatile. Credit markets have shown stress fractures, and liquidity conditions have quietly tightened in ways that rarely make front-page news. When liquidity tightens unexpectedly, capital looks for safety, and safety, for thousands of years, has meant precious metals. Now contrast that with equities. Stocks are still priced for optimism. They're priced for soft landings, steady growth, and controlled inflation. But what happens if the next 48 hours challenge that narrative? What happens if incoming data shows that inflation is re-accelerating or employment is weakening faster than anticipated? The Federal Reserve would be cornered, tighten further and risk recession, or pivot and risk inflation reigniting. That dilemma alone is rocket fuel for gold and silver. Silver amplifies whatever gold begins. Silver is not just a monetary metal, it's an industrial necessity. Solar panels, electric vehicles, advanced electronics, medical applications, silver demand is structurally stronger today than at any point in history. Yet mine supply has not meaningfully expanded. In fact, several primary silver producers are reporting declining or grades and rising extraction costs. That means even if prices rise, supply cannot instantly respond. The elasticity simply isn't there. Now imagine a scenario where monetary uncertainty drives investment demand higher at the exact same time industrial demand remains strong. That's not a slow grind upward, that's a repricing event. Over the next 48 hours, one of the most important indicators to monitor will be the behavior of the dollar. If the dollar weakens sharply on dovish language or weak data, gold will likely break technical resistance levels that traders have been watching for weeks. Once those levels snap, algorithmic buying accelerates the move. Momentum traders pile in, short sellers cover. What starts as a measured rally can quickly turn into a vertical spike. We've seen this before. The early stages always feel uncertain, then suddenly price moves faster than logic. At the same time, watch the futures market positioning. If commercial hedgers begin reducing shorts while managed money increases longs, that shift signals that even traditional suppressive forces are stepping aside, and when resistance steps aside, price moves freely. But here's where psychology becomes critical. Most investors hesitate during the first breakout. They tell themselves it's temporary. They wait for a pullback. They demand confirmation. By the time confirmation arrives, price is 20% higher and premiums have widened dramatically. The opportunity wasn't lost because it didn't exist. It was lost because of hesitation. That's the emotional trap. Now let's talk about physical availability. In tight markets, physical shortages show up before spot prices fully adjust. Dealers begin limiting quantities. Delivery times stretch. Secondary market premiums climb. These are early warning signals that the paper price is under pressure. If over the next 48 hours you begin seeing out-of-stock notices on high-volume silver products or dramatic premium expansions, that is not coincidence. That is stress working its way through the system. There's another dimension here most commentators ignore: sovereign behavior. Central banks do not telegraph urgency. They accumulate quietly. Recent reserve data shows consistent gold purchases from non-Western nations. That's not speculative buying. That's strategic positioning against currency risk when sovereign entities diversify. Reserves away from dollars, they aren't chasing momentum, they are hedging systemic exposure, and when sovereign behavior aligns with retail awakening, momentum compounds. So what should you do? First, clarity. Decide your objective. Are you hedging systemic risk? Are you seeking upside leverage? Are you preserving purchasing power? Your strategy should reflect that clarity. Core physical holdings provide stability. Select mining equities offer torque to rising prices. Streaming and royalty companies provide asymmetric exposure with operational insulation. Second, act before comfort arrives. Comfort is expensive in markets. When headlines confirm the move, the value proposition is already diminished. Third, manage position sizing rationally. Volatility cuts both ways. Precious metals can surge rapidly, but they can also retrace violently. Strategic accumulation beats emotional overcommitment. And finally, understand this truth. Markets reward preparation, not prediction. You do not need to forecast the exact headline that triggers movement. You need to recognize when conditions are ripe for movement. Right now, conditions are aligned in a way we have not seen in years. If the next 48 hours pass quietly, you lose nothing by being prepared. But if they ignite momentum, preparation becomes profit. This is not about panic, it's about positioning. Because when confidence cracks, capital migrates, and when capital migrates, it moves fast. The investors who thrive are not the loudest, they are the earliest. We are standing at a potential inflection point: monetary tension, geopolitical uncertainty, constrained supply, rising sovereign accumulation, fragile confidence. Alone, each factor matters. Together, they create acceleration. So as the clock ticks forward, stay alert, watch the dollar, watch bond yields, watch physical premiums, watch inventory levels, watch central bank rhetoric. But above all, watch price behavior around key technical levels. Breakouts from compression zones often precede sustained trends. The next 48 hours may not just move price. They may reset perception, and perception is everything in markets. If gold establishes a higher trading range and silver confirms with aggressive follow-through, we may look back at this window as the moment complacency ended and repricing began. Opportunities like this do not announce themselves politely. They emerge quietly, then move violently. Position accordingly.